Hello, everyone. This is Bill Sarubbi on Tuesday, June 22nd, speaking on behalf of the Foundation for the Study of Cycles, which I am a board member. And I joined the foundation way back in 1972, and I have used I've used cycles many times in my career as a fund manager. And as a strategist and an analyst. So I'm a big believer in cycles. I'm very happy to be part of the foundation. Yesterday, you heard my friend and colleague Jake Bernstein speak. I was very happy to listen to Jake because he gave great credit to someone who inspired both of us. That is Arthur Merrill, who wrote Behavior of Prices on Wall Street and Filtered Waves. Art inspired me. He was in New York when I was there. And tomorrow you'll have my friend Andy Pancholi. And although all three of us do cycles, we all have different approaches and add different degrees of value. The foundation is probably, I guess, the world's greatest repository of cycles, information, and analysis. And I don't think it has, number one, been looked at that seriously. That's been my opinion. I've worked for big financial institutions. They don't take it that seriously. But these days, we have a whole new crop of quantitative analysts. We have high-powered software. We have artificial intelligence. And I agree with what Jake said yesterday, that we're just getting started. So it's not too late to climb on board because you may have a unique contribution. And I think the old way of doing things, like when I was at New York University, where all investors are considered rational, and that is the beginning of all investment modeling, I think that will fall by the wayside under the weight of the evidence in the coming years. So this is the outlook that I have conveyed to my clients, institutional and individual. And by the end of this year, I expect the S&P will be higher than it was in January, but a correction may be in the offing right now. I think US notes will go lower, the US dollar higher. I think gold will be higher after August. Oil is probably the most consistent uptrend. I've been saying this for quite some time, and I'll talk about that when we get to oil because I was in the Middle East for 14 years. And the real estate top, I think for most people listening, we all own real estate. I think that top will be in 2023. We're in the accelerating phase of the real estate cycle, as we will say. So first, we have to look, as my old friend Teddy Butler Henderson used to say. He ran London's the biggest investment house, and his father ran it before him. And everyone in London knew Teddy. And he would say, you have to understand the fundamental situation. So to me, the most important thing to understand is liquidity. This is the Fed balance sheet, and it will hit 42% of GDP. And you can see this goes back to 1914. So if you thought the inflation in the 70s, inflation of the currency was bad, that's where my pointer is. Look where it is now. So when I was born in 49, so in the 50s, my relatives would say, Billy, a cup of coffee used to be 5 cents in the 30s. Now it's all the way up to 10. Well, what is a cup of coffee today? What causes the coffee, the real estate, cars are not getting more valuable? Each individual Federal Reserve unit unit of currency is getting cheaper because we're printing too much. Too much is defined by well over and above the demand for dollars to do effective commerce. And by the way, the Byzantine Empire had a stable currency for 800 to 900 years for a simple reason. Inflating the currency or printing too much money was a capital offense. If you did it, they killed you, so there were no repeat offenders. And there have been stretches of history where currency has been stable. So as I tell students, because I go to universities frequently to find out what's going on. Sometimes they ask me to speak. Richard Cantillon was a shadowy figure. We don't know much about him. He was an Irish-French economist and author of Essay on the Nature of Trade in General. And William Jevons considered this to be the cradle of political economy. He indicated that the king's expansion of the money supply had effects, not all of them favorable. This, of course, made him very unpopular, which is why we don't know what happened to him. There are rumors that he's still hiding out, that he took his own life, assumed a different identity. And he let us know that when excessive liquidity was created, as something that was not known before. It benefited certain people. The people who were first in line benefited. And then the overall rise in the general price level was not favorable for people who were unprepared, but particularly people who are on fixed incomes or are poor. So figuring out where all this liquidity is going to go is the great challenge. And I've told this to students in graduate schools. They're not going to stop inflating the currency. Now, my analysis of the markets, this is a histogram month by month of all post-election years running back to 1885. There have been 33 or 34. And you're looking at the expected return. In other words, the probability that it would be up times the percentage appreciation. So for example, if I put this cursor right here in April, you'll note April has been very strong in post-election years. That number, 1.5, I don't know the exact numbers, but let's just say it's up 3%, 50% of the time. Well, 0.5 times 3 will give you 150, which is what we see here. So it combines the likelihood that it will be up plus the magnitude. So that's post-election years only. That's the 4-year cycle. Now, there is a 4-year cycle, and as my late friend Ian Notley pointed out, they say it's the election year cycle, but it existed before the creation of the Federal Reserve in 1913. It exists in countries where they have 4-year election cycles, 6 years, 8 years, or no elections whatsoever. In other words, there's a 4-year cycle. So we don't know if it's linked to elections or not. The other important cycle is the 10-year cycle, which is the decennial cycle, which was Edgar Lawrence Smith at Ameritrust Bank in the 30s noticed that years ending in 5 had the best returns. Years ending in 7 usually always brought some sort of financial crisis. Years ending in 2 was where we had most bear market bottoms. Years ending in 0 had the worst returns of all. So if I combine 1, 4, and 10 for this year, this is what I get. And as you can see, we're about here. So will there be a strong July or not? Let's go a little further. Now, my approach is to look at all the seasonal cycles and the cycles which I've just shown you, which I regard as static in that they don't change very much. They will change as the years go by, and I've sectioned it off, done it decade by decade, divided it into 50-year chunks, and it is relatively stable. This is the dynamic monthly cycle, which was updated as of the close Friday. That is all other cycles that are currently in effect. And we run a statistical test, and then we run a second test to determine which cycles are profitable, because I'm not in the running for the award for quantitative finance right here. We're trying to make money. And so this points down. So let me just go forward one. Okay. Next, we see the dynamic weekly cycle, and you'll notice this sell signal came in a bit late. The market topped back here, which was the decline we saw last week. So since 1950, now this is another cycle. They call it sell in May and go away. You can also call it buy in autumn. Most gains, 93% of the S&P's average annual 9% return has been accrued during the 27 buy in fall or buy in autumn period, October to May. BIF is up in 57 of the last 71 years for an average gain of about 8.5%. Sell in May is up in 46 of 71 years for an average gain of 0.6%. So since 1950, buy in the autumn has outperformed sell in May in 57 to 70 years. But last year, in 2020, due to that, or whatever you want to call it, COVID-inspired mini bear market that we had that ended in March, sell in May, the weak part of the year, outperformed buy in fall. But since 1950, the sell in May has never outperformed the corresponding year's buy in autumn in 2 consecutive years. So that's another negative for this period. We're in that period right now. So this is, let me just see where I am. Okay. This again, now this is the histogram, but it's got all of the bars in. So this is what you just saw. This is the expected return. That is in blue, the average percent change. And if you multiply blue times red, you get green, which is the expected return. So that's the likelihood that it will be up. This is the amount of return, and that's the product of the other two. So as you can see, we are This is for post-election years only, and there's a bit of a conflict here because it does show July, as the previous few slides ago, we saw that July tends to be up. Now, this is all years ending in 1. And as you can see, the week, again, April is strong, but note this period here tends to be weak. So this is beginning to reinforce what we're seeing between buy in autumn and sell in May. And you'll note that September comes across weak no matter how you look at it. If we look up here, September, look down here, September. So let's combine the two. Now we have 13 of these years. We had 33 years after the election, 13 years ending in 1, but there've only been 6 which have combined both. That is all years ending in 1 that have also been post-election years. And again, note now, one of the reasons that I was so bullish in April was this: no matter how, now Charles Jane used to say to me, he said, Bell, you know, an investment is like a diamond. It has many facets. And as you rotate it, you look at all the different facets to try and get the whole picture. So doing that with cycles, all of them showed the period through April to be very strong, with April in particular being very powerful. Now in May, we were about flat, depending on which index you look at. In June, I had predicted we'd be up in the first half, down in the second. And July, now here, if you combine them all, July is not so strong. It's about an average month, but then August and September are weak. So that is my forecast right now. I believe, and by the way, 60% of all S&P returns come in Q4. That's October, November, and December. So that is how I put it together. And this is the relative strength as of Friday of the sectors. You'll notice energy is number 1, real estate is number 2, technology number 3, down at the bottom, consumer staples. I'm not too surprised, and I expected this for one reason. Remember the Cantillon effects? In 1980, it was 98, 99, or 2000. Felix Zulauf from Switzerland came down to Abu Dhabi when I lived there, and he said, you know, Bill, we're at a big cyclical change. I said, I think I know what you're going to say. We're having a year ending in 0, worst year for the stock market, but the central banks keep cranking the money out, especially when there's a crisis. So where is that going to go? And both he and I agreed that for oil, there's an old blues song, been down so long, looks like up to me. We both agreed that oil would be a beneficiary and gold. In other words, valuations were too pricey in the stock market. It was a year ending in 0, which is bearish. And where do most lows occur? In years ending in 2, what month has seen the most bottom? It was October. So I immediately made up a forecast, which took about as much time as I just took telling it to you. I'll say something about big institutions later. They're appalled by that, by the way. If you get it right and you take very little time, if you slave away for hours and hours and have a big complicated report and it's wrong, that's great. You're there for life. So energy, this period is very much like the period that we saw back then. I think energy is in a bull market. I've been saying this since Q3 or Q4 of last year. I don't think it's going to fade away or go away. At the beginning of a bull market, as is typical, we don't know what the fundamentals are going to be. You have to be creative, and relying on history is a great teacher. So no one knew. We didn't know the outcome of the presidential election. Now that the election has been completed, the new administration stopped the oil pipeline and is actually capping wells. So now we know the reason for the bull market. Well, that usually occurs about in the middle of the bull market when the fundamentals become known. So I don't think it's over. Well, real estate, there's not that much for this particular sector. There's not that much price data. I think it's only 6 years. But you'll see. I mean, I think everybody listening to me knows real estate is way up, and that's why that group is, that sector is number 2. Technology. Well, technology, back last September, I didn't think the relative strength of the FANG stocks could go any higher, but I did not think technology would go down. So what is the only logical outcome? The smaller, lesser known technology names were going to rally, and that's when I bought Seagate, and I can't remember the names of some of the other, but some of the lesser known chip stocks, and did quite well with them. Seagate now appears to be at the end of that long run, but there are a lot of technology stocks that have no effect on the indices. I read a study in, was it 2000 or 99, that 50 companies in the NASDAQ generate 70% of the volume. Well, there were 5,000 stocks on the NASDAQ. So 50 of 5,000 is 1% of the stocks generate 70% of the volume. So a very small, tiny group, shui shui, as they say in Arabic, could control that index. So that index could actually go down and all the smaller technology stocks could rally. So it's a very tricky sector to handle, but that was, my specialty in the 90s. Now, consumer staples, I'm not surprised they're dead last. I was the value line consumer staples analyst. I had to follow food stocks. Commodity prices go up, they can't raise their prices. Food companies' profit margins get squeezed, and that's why they're so low. And being an analyst during one of those bear markets is very lonely. It's like being in an outpost at the North Pole. Nobody calls you. So I think this is going to hold for the year, if you're wondering about sector allocation. And the only one I'm somewhat uncertain about, healthcare. Lord knows what they're going to do with healthcare. They keep changing the rules and the laws. So stock groups. I also think cannabis, electric vehicles, and solar industries will likely outperform, and crowd control and security, which I'll explain a little later on. Now, here's one measure. I want to show you where we currently are. If you were talking to me at the beginning of the year, I'd say I'm sure we're going to get higher prices into April. After that, I don't know. May, June, they could be flat. May, June, July could be flat, could be down, but I don't think I would be a buyer at that point. Well, here we see that only 2% of investors expect a bear market in the next 6 months. That's extremely optimistic. Now here we show at 36.5% in Q1 21, U.S. households' equity allocation rises to yet another record from 28% a year ago. And hedge funds are fully long. So, and here is Der Spiegel, people riding the rocket of the bourse or the stock market. Now, Paul McRae Montgomery, my old friend from Legg Mason down in Virginia, did a study of, I think it was 2,800 covers of Time magazine. And he found within 3 to 4 months, if there was an investment related cover, it would go in the opposite. That investment would go in the opposite direction to that which the cover of Time suggested, with about 80% accuracy. So you take the date of the cover. Let's say it tells you to sell energy stocks. You add 3 to 4 months, the odds of 80% that there is going to be a low, because it's contrary opinion. And the less financial a magazine, the greater the signal. In other words, the trend is so strong that even People magazine or some magazine that doesn't normally cover financials covers it. So, and this is the all asset rally. Now, there was a saying in New York when I lived there in the 80s that cocaine is nature's way of telling you you have too much money. Well, the current art and collectibles, the auctions are telling me that the economy has too much money. And here's the number one example. An Italian artist auctioned off an invisible sculpture for $18,003. So people have money to spend on that. They also have money to spend for a Tiger Woods card, went through $344,000. A Kobe Bryant basketball card made $1.8 million, making it into the top 10 cards of all time. The first Dr. No poster from the James Bond series, 20,000 pounds. Super Mario game, unopened and left in an office desk drawer since '86, sold for $660,000. And first comic to feature Superman, Action Comics #1, $3.25 million, a new record for a comic book. And there he is throwing a Volkswagen. So, and here's the Sarubbi sold an NFT pixel for $1.3 million. It's a gray pixel that fetched $1.3 million. And you wonder why coffee went from 5 cents to 10 cents to where it is now. So that's telling me there's far too much money in the economy. And when I was an analyst in New York in the 70s, it was an inflationary period. And let me just explain how this affects fundamental investing. Profits go up, but if you have, these are called inventory profits. If you have a product that you sell for $3 and it costs you $1 to make it, and you've got a bunch of these products sitting in a warehouse, and suddenly inflation enables you to sell them not for 3 but for 4. Well, your profit margin, your profits went from, your net profit went from 3 minus 2, which is $2, to 4 minus 1, 3 minus 1, which is $2, to 4 minus 1, which is $3. So if you look at the income statement, it looks like the profit's going way up, but those are illusory inventory profits. And a fellow, I can't remember his name at the moment, a very bright guy in New York, did an analysis, and he said PE ratios move inversely to inventory profits. And he said, I'll never forget what he said. It's as though investors have X-ray eyes. They can see through the earnings in the financial statement, and they realize that it's not real. And that was one reason for that great bear market, 69 through 74, where the Dow fell by 50%. And in fact, in December 74, when the market bottoms, I saw road signs that said, survive in 75 or stay alive in 75. That's how bad it was. So let's now look at bonds seasonality. So the starting point for all of these analyses is always the annual cycle. And I talked to Richard Mogi, who was head of the foundation for about 8 years. And I said, Richard, after all of these years, I've come to the conclusion that when you start doing cycles work, you look at the annual cycle first, because there's a temptation to look at 100-year cycles, 12-year cycles, 20-year cycles. And he said, yes, he had found the same thing. So we can see that bonds seasonally are their weakest in March. And they certainly were extra weak this time. And they tend to recover a bit April, May, June. And June, almost all of that weakness is in this time period. The second half of June is very bearish. But then you have July and August are the 2 strongest months. So I am short the bonds right now, the 10-year note. But I am warning clients that by the end of this week, or certainly by next week, I'll cover those short positions, because I don't want to be holding shorts in front of this. And then we go out into September, and almost all of that weakness in September is in the 3rd week of the month. So this is 39 years worth of data. And by the way, I was in New York University's library a long time ago, and I came across the Statistical Journal for Manchester University, dated 1890. And there was a study in there about reserves in the Bank of England. And it said that in the previous 50 years, which would be 1840 to 1890, that reserves tended to hit a low in the month of October. And the explanation then, they thought, was clear. That was an agrarian economy, and that's when the harvest tended to come in. And they somehow linked that to the bank reserves. But October, as we still know, it is the month with the most stock market lows, the most volatility, but it usually closes on the upside. But it's also had some of the biggest drops. So that's seasonality is just universal. And I think you can certainly see that in reading Ed Dewey's book about cycles. Now, that's the bond seasonality. Now, this is the monthly cycle on the US note. Now, we had an anomaly here where as stocks did, it rallied, but now we're in this part of the curve, and we're coming into July. But just the same, I am going to cover, let me see what is next. Okay, I am going to be covering shorts in the notes sometime in the next week, because I'm expecting a strong July, August. Now, let me just answer a question. Some people may be wondering what the order of strength is here. The dynamic cycle you're looking at was constructed from the most recent data that went through two tests. And as far as I'm concerned, that is the cycle. It is modified by the annual cycle, which is static, and the other cycles like sell in May, election year. But this cycle dominates. So the best possible combination would be to have all cycles pointing up or all cycles pointing down. Most of the time it's mixed. So I go with the asset class, which is most clear to me, which is energy, which is where I'm overweighted in terms of stocks. If everything points down, then I'm short that area. And if it's mixed, then I reduce my allocation. I don't look at those asset classes at all until I straighten out. Or you can assume a trading range. And you assume a trading range by marking off the last high and the last low, and you operate under the assumption that it will not exceed that high or penetrate that low. So when it gets up and it gets oversold, near the prior high, you can short it with some degree of confidence following daily and weekly cycles. So that's how to handle those positions. All cycles point up, all cycles point down, or the message is mixed, in which case you probably have a trading range. Now, there's nothing to 85%. Richard Diamond, who was a professional trader all his life, I was a student of his, said that I invest when I'm 85% certain. If you're 100% certain, you're probably wrong. So 85 is the limit. And he said, well, there's a healthy degree of doubt. It's usually where you are correct. So I don't expect all the cycles to always give me, for example, the US dollar was, this cycle on the US dollar was completely wrong last month. And I had to rerun it. And I have an element in the software that is monitoring the trailing behavior of the previous 12 months of that cycle. And if I see returns start to turn negative, that means I have to think about re-optimizing. That's how I monitor the integrity of the cycle. So let's go down one more. Now here is the US dollar cycle, which was just re-optimized. And you can see that big rally that was on Friday. And this is telling us that for the rest of the year, the dollar is probably going to rally. And having lived overseas for 31 years, I can tell you that as one of the big Arab fund managers in Abu Dhabi said, the US has the best combination of legal protection, opportunities in real estate and technology in particular, and a sound banking system. And so when the United States catches a cold, the US gets, the rest of the country, the rest of the world gets pneumonia. So a lot of people I know from being overseas, they see the US as being a good place to invest. So it is not surprising if things are getting difficult, people put their funds in dollar denominated assets. Now here we're going to switch over to gold. Now this gold seasonality, those bars stay about the same. Okay, they stay about the same year after year. And that is my general rule of thumb is if you're in a bull market in gold, then June is usually the low and you have a great run from June through the middle of October. If a bear market is in effect, then the low is usually in October and it extends usually in August and it extends to the middle of October. This means that month of September is up 61% of the time for an average about a 1% gain. And the August is up 60% of the time, but it's only a 0.5% gain. No, it would be 0.8. So these are the strongest months of the year. You generally don't want to be short gold in that time period. Now, let me also just step aside for a minute. When one of these does not work, there's a facility in the software that will flip and tell me that because this bullish period, let's say from here to here, if gold goes down, the software will tell me what to expect, how it will deviate from the normal seasonal cycle. So if it should have gone up and it goes down, what does that mean? If it goes, if it's a very bearish period and it rises, most of the time it indicates that the cycle that you were the weak or the strong cycle was overridden. Sometimes it doesn't. Oil is a good one. If oil in terms of monthly data, if it puts on an exceptionally strong rally in April and May, which we'll see are the strong months, that doesn't really mean very much going forward. So, but anyway, this is a gold seasonality. Right now, where are we? We're here in June, which is about flat, very volatile. I expect it to go a little bit lower by the end of the month, and I'm expecting a low somewhere in mid-July, and then a good run up until the middle of October. So that is the current cycle. That is the monthly cycle, same as the previous two. And you'll notice it bottoms in August. And what do we have in August? So here we have a confluence or agreement that August, September will be strong between the static cycle and the dynamic cycle. And once this is done, I look for confirmations like I just showed you the magazine cover and all of the confirming statistics, which will not always be 100% in your favor. You have to pick and choose as to which ones are going to be the most helpful. So here's gold sentiment. This is gold market timer sentiment. Look where it is. It's down here. Are people bearish? Yes, they sure are. This is from Hulbert Holbert Gold Newsletter Sentiment Index. And there's the oil annual cycle. Now, this is very clear. October, November, usually very bearish. Then you have a run from October through April. This is much like buy in autumn and sell in May with stocks. And if, as I said, if oil is extra bullish in here, it generally does not affect these numbers in May, June, July. But right now, where are we? We're in June, and with the dynamic cycle, there's a dynamic cycle, with that pointing up, what does that mean? Well, that means February, March, April, I was pounding the table. May too. Here in June, July, what am I saying? I'm saying, yes, it's going to continue to go up, but at a more gradual pace. In other words, this seasonality, which is average to week in here, is overridden by the dynamic cycle. Now, if that dynamic cycle is still pointing up, and August tends to be one of those pivotal months, like if January and April are both up in terms of the Dow Jones Industrial Average, that's a very positive augury for higher market at the end of the year. August is sort of a pivot month for oil for some reason. And then, of course, there's very little that will help you over here. If the month of September is unusually strong, it means it has farther to fall in October and November. It's hard to overwrite that for some reason. Now, there is the cycle, and you'll see it shows higher prices up till October, and after that, a sell-off. Now, this one is of particular interest to me because my father and grandfather were both builders and always tried to get me into real estate. And even though I haven't gotten into it, I am very fortunate when it comes to real estate. And most of this information comes from my friend Phil Anderson, who wrote The Secret Life of Banking and Real Estate, highly recommended book. This real estate cycle was credited to Fred Harrison in his book, Boom Bust. And it's an obscure book. Now, I'm very grateful to Phil for retrieving it from the dustbin of history. It is 18 years in length. Now, again, go to the archives of the foundation, look at Ed Dewey's Encyclopedia of Cycles, and you'll find lots and lots and lots of 18-year cycles. They'll break down. Half of that is 9 years, double is 36, triple is 54. It breaks down into a sequence of 477. There was a 4-year crisis or bottoming phase. And I think everyone out there knows when the bottom was. It was 2007 to about 2011, somewhere in there. That was the low. That was the bear market. That is usually followed by a very gradual 7-year recovery phase with moderate price rises. People are so traumatized by what happened in the bear market because, as we know, real estate always goes up. Famous last word from AIG during the great crisis that nearly pulled them under. That's the type of thinking that you have in big institutions, which is why I don't work there anymore. And then there's a 7-year accelerating phase. Now, let me switch so you can see a graphic. Now, this is right from Phil. 2016 was the election year. So I had projected out 7 years, and I chatted to Phil, and he agreed. He thought the accelerating phase would run 016 to 023, and here we are. Winner's curse, that's the last 2-year phase where you get a hyper acceleration. And I won't go into it in detail, but the first credit unions in England had a loan system in which everybody contributed and someone get money to buy a house. And it had based on the interest rates charged, it had a 14-year payback period. It was 14 or 18 years. But Phil thinks that started the cycle. Obviously, the financing is different now, but that's an interesting observation. So we had a period of shock up until 2016. Then we had a new election. A new administration came in. It was more optimistic. It was more Reagan-like. And that set off a boom, which we're now in, and we're headed toward 2023. So 2023 to 2027 is probably a period of weakness in real estate and real estate liquidation. This is a pretty regular cycle. Now, remember, I said I try to confirm these things with the real world. Well, first of all, this is real estate activity. That is the number of voluntary real estate transactions, regardless of price. Let me repeat, it's the number of real estate transactions. So the sale of a $100,000 house would be the same as the sale of a $1 million house. There's no waiting. And as you can see, it's rising off of that low. First of all, it has a little double low, 2010, 2019. And I like this because it gives you a different perspective. So here, the dominant cycles are right now are 82, 48, and 66 months. And that red line shows a little peak here and a little bottom down here. So we're past that bottom. We are in this accelerating phase. So does the number of real estate transactions match the 18-year cycle? Yes. So we have a confirmation. So we're a little more confident that this is going to be an accurate prediction. So now, signs of an impending top. Record share of home buyers make offers sight unseen. So this is the highest level since 2015. At any point in your home search process, did you make an offer on the home you hadn't seen in person? The shares of respondents who said yes, 63% buying without, willing to buy without having seen the home. That is the definition of optimism in real estate. Housing prices to consumer price index. In terms of inflation adjustment, are housing prices high? Well, yes, and in fact, it's approaching the last top. You see that in 2006. Now, valuations are extreme. This is real estate assets relative to financial assets since 1925. Look where we are. We're down here. So my observation is that the investment frame of mind flips very easily. So it goes from I can't get enough real estate to I have too much real estate and I want paper assets. I want something else. Or I have too much paper assets, I want hard assets. It goes back and forth. And I have a friend who in Greenwich Village and back in the 90s, she was sort of crying on my shoulder that people weren't buying her artwork. She's one of the world's top sculptors now. And her 31-foot high bronze divers, that's a diver like a female diving into the water, go for 1.2 million. And I told her, don't be concerned because we're coming out of this paper asset period. In 2000, we'll come out of that and people want to buy hard assets like your sculptures. That's exactly what happened. And if you go right now, if you look at online auctions, you'll see what I mean. The same thing happened back in the 70s. Another sign of a top, if you sell a house these days, the buyer might be a pension fund. It was either Bloomberg or Fox Business was reporting that the housing market is being taken over by large institutions who usually do not invest in real estate. They're buying houses outright and renting them out. So they're taking supply off the market at the time of the demand is increasing. And unaffordable homes, the housing affordability gauge, which comes from, it's an average of price to income and house price to rent indices. It is higher than any previous peak going back to the year 2000. So we're all set up here, but here's homes are less affordable. Home price in real, I think this is a duplicate, in CPI terms. High home prices fuel more spending. These are mortgage equity withdrawals. In other words, I have a $1 million house, the market value goes up to 1.5. So I've got 500,000 in unrealized profit. So I'll borrow into that and I'll spend it on something else. So as you can see, it's approaching the previous high. And here you go, my where I'm headed in a few hours, back up to my old haunts in Greenwich Village in Manhattan, where, you know, who would have thought that the real estate market would turn like it has? This is Manhattan average rents, lowest in a decade, from $3,500 a month, approaching $2,500 a month, probably even lower right now. And that's kind of hard to believe, having lived in Manhattan for so long. So whenever somebody tells you something always goes up, if it's real estate or anything else, just look at the price history. That is absolutely not true. And by the way, the place I'm sitting in right now is a co-op, which is 1,200 square feet in Monroe Township, New Jersey, bought in May of 2012 for $25,000. Similar units are now going for $100,000. up 4 times in value since I bought it. So has this cycle been useful to me? Yes, it sure has been. So back at the beginning, I said I'd mention later why I'm in favor of security-related companies, whether it be software security, personal security, it could be burglar alarms, any method of defense. This is Wheeler's war cycle. Now, Professor Wheeler and the foundation is very fortunate to have his works in the archives, gave his graduate students the task of going back and creating it's actually an index of battles going back to BC times, BC before Christ, and taking it up to 1950. Now, from 50 to 90, Richard Mogi, my friend, who was then director of the foundation, hired a mathematician to extend it. So it runs BC times to 1990, has not been updated since. We don't know the exact formula. It's been sort of lost, but I can tell you it's based upon the amount of collateral damage in real dollar terms. It is based on the percentage of the population involved in the battle. It is also counts the number of countries involved in the war. Wheeler was trying to measure what he called battle intensity, how ferociously they were fighting. And this is here we go again, 18 years, and you see the cycle peak here. So I was telling everyone in Abu Dhabi the Gulf War was ending. Now, what was the fundamental? I called my friend Jim Dunnigan at strategypage.com and I said, Jim, what do you think? And I said, well, Bill, I get the word right from the battlefield because he's a well-known author. When the Allies, the Americans and their allies, overran enemy bases, they found hard drives and thumb drives, which had the locations of all the leaders, all the safe houses. So the media didn't tell you this, but they hit them all at once in different countries, Egypt, America, throughout Europe. Did anybody out there read about this? No, and that is why they collapsed. They had no command and control. The leaders were all rounded up. The cycle pointed to the time, the fundamental. Again, you have to dig a little bit to get it. Jim's an expert, and that's why I rely on his advice. So where are we now? So the way this works is this is the 18-year cycle. If you're victorious, what do? You tend to relax. Remember, the United States fought a two-front war and won, and in 1951 couldn't stop the North Korean 1st Tank Division. That's how fast the military can run down. And so at the bottom, aggressors become emboldened enough to begin attacks, and the strong man wins again at the cycle peak. So where are we right now? Well, right now, the strongest cycles are 90.4 years, 18 years, and 60. Notice the 18 shows up, and 60 and 90, that number 30, 15, 30, 45 tends to dominate in cycles. And so this is an old graph. I wanted to show you an old one. So you'll see right here, we are at a low running up into a high. That's about 2024. Well, the new administration is in, and the early returns are that aggressors are becoming emboldened by their action or lack of resolve. So again, I think the cycle is right, but you'll notice now that this cycle peaks in the same year that real estate peaks. So there might be, you start to look for confluence between cycles to determine what actually will happen. And now, what did I mean when I said security? Well, AMMO, that is the name of the company, AMMO. Its ticker symbol is POWW or POW. I believe it's in the pink sheets on the NASDAQ. They make regular, normal old ammunition. Where was the stock trading? Over here, 2020, less than $1. It's been as high as 10. So that's what I mean when I say I'm looking for, right after 9/11, I'm looking for security-based companies. Right after 9/11, a lot of them were taken over. People who make body armor, people who sell security services. And by the way, this is the way the pirates who are operating off the coast of Africa, private security came in. It was hired by the shipping lines, and that put it, there's no way the pirates could match up against professional soldiers. And this is Axon. You'll know Axon better by its early name, which is Taser. They changed their name. So it's gone from $10 a share to as high as $210. It's currently running around $150. So those are the types of stocks. They're few and far between. Most of them privately held, but when you find them, big investment firms find them too and drive the prices way up. And now here's an interesting question. People ask me my opinion about Bitcoin. Well, I've sat with professors at the Von Mises Institute, of which I am a member, which is located down in Auburn, Alabama, and as a part of Auburn University. And what is Bitcoin, fellas? And they all agree it doesn't fulfill all the requirements of being a currency, but it is a medium of exchange. They all agree on that. And I also managed to ask people at NYU, Stevens, Rutgers, Princeton, and the universities in Vienna. And in fact, the Institute of Finance and Economics, which is one of the newer universities in Vienna, is opening up a digital currency blockchain department. So I think it's very obvious. It's the free market in operation. People want to get away from paper Federal Reserve notes because if you produce too many of them, the purchasing power goes down, and people want to preserve their purchasing power. So I think that's one. In Bitcoin, obviously, you can have anonymous transactions. It's people trying to find freedom from too strong a government. But my question was, what if we all create Bitcoins? What if we create a foundation Bitcoin and a Bitcoin for everybody listening to this broadcast? What happens? Well, here is digital greenbacks, weekly value US currency versus cryptocurrency. We'll look at cryptocurrency. So let me just take one forward here. Okay. That's the current situation. I think it's going to resolve this way. Trouble for Bitcoin, GovCoins, the digital currencies that will transform finance. While I was in New York a couple of years ago, I met with Matthew Mellon of the Mellon banking family. He was the backer of Bitcoin, made him very wealthy. And I said, how's it going? And he said, well, the government has contacted me. They're interested in creating a government digital currency. And I think I'm going to work with them because I've had the experience of obviously putting one of the early Bitcoins, getting it operating successfully. So they want to talk to me. And I said to him, when I think of new industries, I always think of the automobile industry in the 20s and 30s when there were Duesenbergs, Studebakers, the Stutz Bearcat. All of those automobile companies are gone. And in the future, I think we'll look back at the Bitcoin period, and you'll probably see Bitcoin, Ethereum, and some of the bigger ones. But if the government gets involved, they can usually offer incentives that private industry cannot. They could offer a tax break. They could say, well, if you pay your taxes in these Bitcoins, we'll give you a 0.5% discount. They have advantages that the private industry does not have, particularly the small ones. So I think the bigger ones will adapt, but the smaller ones won't. So I think the number of digital currencies will decline, but if you're in the main ones, it's like years ago when I was running the technology portfolio at Abu Dhabi Investment Authority, I said, well, guys, Apple made a mistake early on. They made their system a closed system. IBM, their PC has an open system. I bet my money on IBM, and that was like 1990, 91, 92. So I have a few more things to say, but let me just say that I'm in Forbes.com, Bill Sarubbi, great speculations. And of course, the foundation, as you know, has returned. Otherwise, we wouldn't be here today. But I wanted to say we have a few more minutes. I just wanted to say a few things about cycles, where I think it's going. And my opinion is that almost any part of human endeavor history can be turned into a cycle. We may not have numbers. We may not even have accurate numbers. But you can take things like I get into debates with my friend, Professor John Casti, author of 16 books on mathematics, who is the head of the X Event Center, who wrote a book called X Events. And he's saying that planning leaves out these random effects like the blowing of a volcano, and these threats are not really dealt with. And his thesis is the more and more complex a system becomes, the more and more likely it is to break down. And a good example was the Austro-Hungarian Empire, which was so wide that it took forever from a message to go from one end to the other, encompassing a number of different cultures and different languages. As a business, it would be very difficult to manage. It fell apart. So I said to him that I visited the robotics lab at NYU, and they introduced me to Caesar the robot. And they controlled the robot. And I asked what software, what language they used to write the software. And I said, well, we didn't write the software. I said, where did you get it? And they said, well, there's a company that writes software to control robots. I went to NYU's. Now, I was in the computer game business with a company called QQP for 5 years. I went to that is now part of the School of Arts at New York University. So I went to their weekend, which is called Practice. And I talked to the guys in the industry. I visited their companies. By the way, we used the C language, our programs, to make our games. What do you use? Well, we use this. I said, I never heard of that language. No, it's a company that has produced software that makes games. So I'm thinking if you have a big, complex software system controlling your power grid, and the guy who wrote the initial software is no longer around, yours could be set up for quite a catastrophe. It's like pulling a big stack of soup cans in the supermarket, and you pull the bottom one out and the whole pyramid comes down. That is the type, John, that I try and think of. And one of my subscribers' clients was formerly the head of risk control at a Texas energy company. And he said he had the most difficult time getting people to think that such things can occur. Instead, they focus on the obvious that everybody expects. I said to John that I think it should give me a list of what you consider to be X events. I'll bet I'll find a cycle in it. And there are cycles in color. We know that from the old Society for the Investigation of Recurring Events that had fashion people come in. And Elliott Wave International has picked up on that during downbeat periods, people dress in drab colors. During the 60s, does everybody remember mini skirts, micro skirts, and bright colors? So there's an ebb and flow of pessimism and optimism. That to me is in control. That is what's controlling the fundamentals. You could create a great idea of a beautiful, colorful suit during a depression, and nobody's going to buy it because their mood is so down. And this extends throughout all of human endeavor. The war cycles, peace cycles, cycles of technological development are pretty difficult to key in on because who knows what people are going to invent. So I'll take. Do we have any questions? So I am not seeing the. Okay, I am going to.
Bill, there's a question. I
Yes.
can read it. So one question is, what is the smallest reliable cycle time you have observed in the financial index markets?
Well, it depends. You break it down to daily, weekly, monthly, and in the U.S. 10-year note market, it generally goes in this sequence: 3, 5, 8. In other words, if you're in a strong market, it declines for 3 days, then rallies for 5, or it declines for 3 or 5 days and rallies for 8. And of course, I'm sure there are cycles intraday, but I'm just limiting my comments to daily.
Yeah, thanks. So another question was, it would seem that the agricultural products like soybeans or wheat would have strong seasonal associations. Are you following these seasonal associations also?
Yes, I do. I did not make them the part of the presentation because I generally only follow commodities in relation to common stocks, like Archer Daniels Midland, which deals in grain. That's a small sector now, so I don't follow the soft commodities very closely. And I also see that Ronald Carlson is asking who is the author of the X Events book. That is John Casti, C-A-S-T-I, who PhD formerly at the Rand Corporation, and then part of the Santa Fe Institute, and he's very big in the quantitative. He formerly was head of the Keynote Circle, which is a group of us futurists. And I see Dr. Berman is asking about commodity cycles. Yeah, well, I feel we're in one of these periods. You know, I follow the broad commodity index more than I do. The only two commodities I follow really closely are gold and oil, because I have a lot of association in the Middle East, and that's what they're interested in. They're not growing wheat down there in the desert. So I think those agricultural commodities are in a bull market. They're going to stay in a bull market for a while. And that was the harbinger of that was the weakness in the U.S. food stocks. And as I told you, the rising agricultural prices really hurt their profit line. So I experienced that in the 70s, and I took that as a signal last year of rising soft commodity prices in 2021. Paul Leopold asked, do you prefer to use dynamic or static cycles? Well, I use a combination of both, Paul. I have to say, if I had a choice between the two, I would pick dynamic cycles. And the whole key of what I call cycles research is getting everything pointing in the same direction, which happens once in a blue moon, as they say. So, but if you force me to pick one over the other, I would pick the static cycles because they're the dynamic cycles because they're based on the data right up until the last close. So are there any other questions? Okay, well, it's been my pleasure to bring you this. Again, I started when I was 17 in 1966, and I stumbled onto cycles because I found out that it covers up holes in other approaches, fundamentals, even technicals. I'll give you a good example. Fundamental analysis, which I've done, is what I like to call yesterday plus 3%. Because if you come out with an investment thesis in fundamentals that is on the outer edges of the bell curve, management will call you into their office, which they did with me many times, and want to know what you know that nobody else knows, and they don't believe in cycles. And as far as technical analysis goes, if you look at Archer Daniels Midland, ADM on the New York Stock Exchange, it has a very strong seasonal cycle, August through December. And then it's very weak January through July. In fact, if you bought and held ADM only August through December, you're up about 30% annually since 1980. If you bought it January 1st and held it till the end of July, you're down about 9% annually. If you simply bought and held, which is what most big funds, you're up 8% annually. So the choice is between 30 and 8. And I used to, even though I was limited to technology, I would shift out of them in the week August to October period. That's how I use the cycle to add basis points. So these are tools I've actually employed, and I agree with what Jake said yesterday wholeheartedly. With artificial intelligence used the right way, I think cycles have an even more exciting future, and I think this is an ideal point to be a member of the foundation, to listen to these presentations, to subscribe to Cycles magazine. And so I think the future, I think that the cycle for cycles is at a bottom and is accelerating to the upside. So if there are no other questions. Okay. It's been my pleasure. Goodbye for now.